Hi, I'm James Robinson, and this is my stock pick of the week. My pick of the week is simply a stock that I think represents a great buy that week. My criteria for what makes a great stock is very simple. I look for great companies with a durable competitive advantage or an extremely good return on invested capital. Only after I find companies that qualify under that criteria do I look at the stock price to see if they are fairly priced. In other words, I look at dozens and dozens and dozens of companies, looking for the companies that I think are very, very solid companies. Once I find a solid company, then I start asking myself, is this a company that can be purchased at a good price? Most of those companies, most of the companies that I think are really good companies are not currently available at a good price, and so we don't buy them. But we put them on our watch list, and I wait, and I wait, and I wait, and sooner or later things change, and every once in a while a company becomes a company that's both a solid company and a company at a reasonable price, and that's the companies that I'm suggesting you should buy. Today's stock pick of the week is PetMed Express, symbol PETS, doing business as 1-800-PETMEDS. PetMeds is an online and telephonic distributor of pet medicines and related pet products. The company is a licensed pharmacy in all 50 states. The company sells both prescription medicines for dogs and cats as well as non-prescription medicines such as flea and tick products, bone and joint products, etc. It sells pet food, crates, beds, stairs, other pets related supplies. The company was founded in 1996. It has 187 full-time employees. The company is based in Delray Beach, Florida. These numbers are as of June 1st, 2019 when I did this report. The company has a market cap of $357 million. It has revenues of $283 million, profits of $37 million. The PE ratio is 9.49. The yield is 4.94, and the company has zero debt. Here you can see my analysis of the company. I rate a company in 29 categories. Operating has 9 categories. Operating is how well they deliver goods and products to their customers. Financial is how well they handle debt and risk. And management is what kind of job they do in terms of returning value to the shareholders. This company has a grade of 3.38. That puts it in the top 10% of companies that I look at. When you look at a company that's got the trading that has a value in terms of the quality of the company, the top 10% of the companies that I look at, that's trading at a PE of 9 times earnings and that has a 4.5% yield, you can understand why I'm so high on this company. The gross margins for this company are not spectacular. They're sort of about average. It's one of the few things that I dislike about the company or that I'm not excited about the company. But again, when you look at all the other factors, I think you'll see that this is a really solid company. Here you can see the earnings and earnings per share for the company since 2001, I guess since 1999. The company has generally been on an upwards projection, a couple of bad years a few years ago, but they seem to have rectified that. The company's earnings are going up significantly. So it's just a very, very solid company. Net earnings is a percentage of revenue. You can see that this company, even though their margins are relatively thin, their net earnings as a percentage of revenue are in the top 25%. So we really like that. So I talk on and on and on about the 4 taxes. When you look at a company, there are 4 costs that a company, really 5, but 4 costs that a company has to bear after they've taken care of their cost of goods sold. That's selling and general administrative, plants and equipment, research and development, and inventory costs. And so I look at those 4 things as taxes that a company has to pay. Usually some company has to pay some significant costs in relation to those things. And I have to look at how they're doing in terms of that. So selling and general administrative, the company is in the top 25% or just outside of the top 25%. That makes it a very solid company. It's not exactly, it doesn't give it a 4-star rating. It's one of the few areas this company isn't doing great. But generally speaking, I think it's okay. It's not disqualifying. In terms of plant and equipment, this is an anomaly. It looks like their plant and equipment costs have been significantly high in the last 4 years, but the fact is in 2015, they bought their headquarters. Not only did they buy their headquarters, they bought a much larger building than they need, about twice the size they need, for $18 million in cash. And so I'm assuming this plants and equipment money is money they've spent into fixing up the place versus legitimate costs. They have no debt on the building. They actually have 2 tenants in the building that are paying them rent. So I would expect that this number is not out of whack and that we're actually doing okay in terms of plants and equipment. So inventory. Inventory is a place this company is doing very, very poorly. It's actually one of the few places that I gave it a grade of 1. the bottom, the worst grade. But if you think about it, it does make a certain amount of sense. They're carrying in their inventory drugs. Those are not things to carry in inventory, cheap things to carry in inventory. And they have to have them. They keep them in their warehouse and they ship them out to their people. So I think it's reasonable to assume that in this kind of business, you're going to have some inventory costs. The counter to that, of course, is R&D. They have zero R&D costs. When you add it all up, again, they're in the top 25% of companies in terms of being able to turn revenue into profits. And so I'm okay with this company. I didn't really give this company, by the way, a great grade in terms of operating. I gave it a 2.89%, which is above average, but not spectacular. Where this company shines is in its finance because it has no debt, and in its ability to return money to the shareholders, in large part because it pays a good dividend. So here you can see that starting to bear out. The company paid no interest, and obviously therefore interest as a percentage of operating income was zero. This is really solid. It means that the company has that tax of interest they're not paying. It means the company has the ability to borrow money should they need to. It means the company is going to turn more money to the shareholders because they're not giving any to the bank. So there's a whole bunch of reasons why I love companies that have no debt and why I'm very interested in them. Also, as an aside, because this company has no debt, I believe this company is a potential takeover target. It's got solid earnings. Those earnings tend to grow. And also I find that companies with no debt, somebody could come in and lever this balance sheet up and use that money to buy the company in an LBO. So I think that's a potential way that usually that's done at a premium to the current stock price. I think that's an additional way we could be rewarded as shareholders. Debt analysis. So here you can see a chart of total current liabilities, total long-term debt, and total debt. The first thing to note, total long-term debt is zero. Second thing to note, total long-term liabilities have obviously jumped up, but so have their profits. The company is continuing money every year. And as you make more and more money, you're going to take on more and more current liabilities. So this chart's spectacular. I love this chart. I have no problems with it whatsoever. I'm sure I gave it a 4 in terms of its grade. So a lot of these charts that I'm going to be showing you for the next few that have to do with finance are going to just be boring. They're going to say there's no debt, so there's nothing to talk about. But it's important to talk about the fact that there's no debt and so there's nothing to talk about. It's one of the things that makes this company so appealing. And so I've, rather than simply ignoring and saying there's no debt, just not talk about it, I've made the conscious effort to go through and say, this is a spectacular thing about this company, a spectacular attribute of this company. So years income to pay off long-term debt. I like a company to be able to pay off its long-term debt in about 3.5 or 4 years. So in other words, 4 years of income applied 100% to debt would wipe out the debt. This company wouldn't have to do that because they have no debt. And so we love it. Again, next category, interest coverage ratio. I like a company to have just under 2 times, to have income just over 2 times the amount that they need to cover the interest. This company has, infinitely high because they have no interest expense whatsoever. So in addition to having no debt, the company is starting to stockpile some money. They're closing in on $100 million in cash equivalents, and marketable securities. It's gone up basically every year since 2013. That means that in addition to paying me a great yield, in addition to having no debt, in addition to buying back some stock, but frankly not very much, this company is able to stockpile money for future growth. I think you're going to see this company's ability to pay money to its shareholders increase. I think you're going to see that increase in part because they don't need to keep stockpiling money. I think that they're either going to make some acquisitions, which I don't like, or start to buy back some stock, which I do like. So we'll see what happens with that. But in general, this company is, you can't fake putting more money in the bank when you have no debt. So I talked about how current liabilities are increasing dramatically, and you can see here their scale of their current liabilities increasing relative to their current assets increasing. You can see that their current assets are many times higher than their current liabilities, which means if they made no money, they could pay their current liabilities for several years if they just made not a penny of profit. So again, rock solid company. So now we're starting to get into finances and their ability to return money to the investors. This is a place the company disappoints me. Shares outstanding, you can see that since 2013 or 12, they've actually gradually increased the number of shares outstanding in a very small way, but I'd like to see them paying that down, not increasing it. Now, I suspect that the reason the shares outstanding are increasing is because they're using that as a way to bonus their executives, But that should be offset, right? That should be offset in ways other than simply allowing us to get diluted. It's a very, very minor thing, but I did give it a low score, and I'd like to see this trend reversed over the next few years. Having said that, if you go back since 2009, the company has net back about 10% of its shares, and we'll talk about that in the next slide. So if you'd owned 10% of PetMed stock at the end of 2008, you'd have owned about 2.4 million shares. Today, through stock repurchases, your 2.4 million shares would mean that your ownership in the company has increased from 10% to 11.83%. So almost a 20% increase in your holdings as a result of paying down shares. And that's despite the fact that for the last 5 years or 6 years, they've bought back no shares and actually net sold shares. Your share of the company's earnings would have gone from about 2.3 million. That's your 10% of the shares of the income from 2009 to about 4.41 million, which is your 11.83% of the profits in 2018. So here you can see dividends, dividends per share. There was obviously a one-time bonus in, and I filtered that out in some of the analysis, but the dividends have been solid, have been going up year after year after year, as well as the dividends per share. So this is the major way this company is returning money to the shareholders, and they're doing it in a fantastic way. We're going to talk more about that again in the next few slides. So when looking at a company's dividends, I look at 4 factors. I look at the yield and growth, which is the obvious. I look at dividend safety in the context of earnings, dividend safety in the context of cash flow, and dividend safety in the context of its current debt load. So let's go through that. Yield and growth. The yield is 4.94%. So just to put that in perspective, the S&P average is 1.92%. So more than 200% of the S&P average yield. In addition to that, the dividend growing at 6.5% a year on average for the last 5 years, which is twice the rate of inflation. So obviously we like both of those factors significantly. Dividend safety in the context of earnings. So what I'm looking at here is what percentage of the net income that the company makes are they paying out to us, the shareholders, and what margin of safety does that give the management in terms of their ability to run the business if things go south, if things turn down, or if they have significantly higher expenses. So their current payout ratio is 47%. The average payout ratio for the last 5 years is 73.9%. The average payout ratio for the S&P 500 is around 40%. So this company's paying out much more, 20% more than the S&P 500 on average. But remember, they have no debt, so they have lower risk factors than the average company. The average payout ratio for the last 5 years is 73.9%. That's significantly high, and I would feel nervous about that. But that number since 2015 has been coming down every year, and now it's in a very manageable state. So I'm comfortable with this number. I don't love it. I don't think it's super spectacular, but it's more than comfortable. Dividend safety in the context of free cash flow. So what we're trying to figure out here is what percentage of the company's cash flow is the company's paying in dividends. And if that number is too high, then it starts to be unsustainable. So what we're talking about is cash flow from operating activities, less capital expenditures gives us our free cash flow. What percentage of that free cash flow is used to pay dividends? If you look at the company's dividend payout ratio for free cash flow in 2018, it's 47.1%, which is not a problem. If you look at that average payout ratio for the last 5 years, though, it's 99%. That's obviously unsustainable. And so I wanted to get to the bottom and figure out what's going on here. In 2014, they paid 99% of their free cash flow and dividends. Again, that's unsustainable. But they had a bad year that year. If you look at 2015, they paid out 44%, which again is pretty reasonable. Then you jump to 2016, and they paid 1,500% of their free cash flow on dividends. Now, what was going on there? That was the year they bought their building. They spent $18 million buying the building. It's a capital expenditure that's very significant, and that kind of blew the numbers. But now if you look at 2017 and 2018, you can see the numbers are 42% and 47% respectively. And so you say, okay, outside of a couple of weird events, this company's dividend payout ratio in terms of free cash flow has been pretty stable. And because I know that they have no debt, and because I happen to know that they spent $18 million to buy a building, I'm going to ignore what happened in 2016 and again say this company's dividend safety in the context of cash flow is not just good, but very, very solid. So dividend safety in the context of its current debt load. The company has no debt. The interest rates could go to $1 million, they could go to 20%, 50%, doesn't matter. This company won't be affected by changes in interest rates. That gives you peace of mind and ability to sleep at night. So you can see a chart of shareholders' equity. You can see it's gone up every year with the exception of a couple of years in 2011, 12, and 13. But generally speaking, the company's been in solid state, continuing to build equity for the shareholders, and there's nothing to say here but wonderful things. Return on assets, which is something I really, really look at solidly. So return on assets is simply saying how much of my money as an owner is this company having to tie up to operate? And then what kind of return are we getting on that? And you can see this company's return on assets is in the range of 25 or 30%. It's spectacular. It's significantly above the top 10% of companies. The fact that I can buy this company paying a 4% yield with no debt at 9 times earnings is just silly. It's just a spectacularly good company. And the other thing to note is that this company in all these categories tends to be sort of chunking along. It's not big ups and downs and ups and downs. And so it's a stable, solid company. The next slide is sort of the same thing, return on shareholders' equity. It is not significantly above in the top 10% because they don't have significant amounts of debt. And if they don't have any debt, then they're not able to goose their shareholder equity, right? So even though they're just sort of above the top 10% last year in terms of this number, they're really able to achieve that despite the fact they're competing with companies that have a tremendous amount of debt and thus have no equity and thus are able to goose this number significantly. So in summary, the first question I like to ask about a company is, does it have a consumer monopoly? I think this company is a small consumer monopoly. Warren calls a consumer monopoly, he likes a company to have a moat, some competitive advantage that allows it to outperform its competitors. Well, its competitors in this case are going and buying your drugs for your dog at the store. That's obviously a pain in the butt. People don't want to do it. It takes a lot of time. And if you're buying it at the store, they have all those costs associated with bricks and mortar, and so they're going to be less competitive. So I think the company does have somewhat of a moat. Part of that moat is that people are just used to using them for the repetitive drug costs. Part of the moat is that they're licensed in all 50 states. And part of the moat is that this is a tiny little niche business that a lot of people aren't interested in getting into. I'm sure, for example, that if Petco or PetSmart wanted to get in this business, they probably could, but frankly, it'd be easier to buy this company than it would be to start over. So it has a moat. It's not as deep as I'd like it to be. Let's call it a shallow moat, but yes, it has one. Is the company solid financially? Yeah, the company has no debt and it has purchased its headquarters. So in addition to not having costs, ongoing costs related to debt service, their costs for their facilities should be decreasing. And in fact, the building's 50% occupied by 2 tenants, and so in theory, you would expect that they might actually be starting to get net income off their property. So it has no debt and likely breaks even at least on its facility costs. Does the company reward its owners? Yeah, the company pays an above-market dividend yield of 4.9%. The dividend's been growing at 6.5% for the last 5 years. Since 2008, the company's repurchased over 10% of its outstanding stock. And in addition to that, almost 20%, by the way. And in addition to that, it's been hoarding cash, which I think is going to accelerate their ability to return money to the shareholders once they reach some level of confidence. The company's earnings have been generally increasing for the last 20 years. So I believe there's 5 ways that we're likely to make money off this stock. I believe the earnings will continue to rise, which will cause an appreciation in the stock. I believe the P ratio for this stock is far too low. Anything under 15 or 18 times earnings is silly. And so I think the P ratio is going to normalize. I believe this company pays a good dividend and that the dividend increases at an attractive rate, greater than the rate of inflation. So I don't mind holding it for the long term. I believe the company will continue and in fact begin again to purchase and buy back shares, which will increase our ownership. And finally, in this case, I believe this company is a stock that is likely to be a target for a takeover or a leverage buyout. I could see PetSmart or Petco buying this company. I could see, BlackRock or somebody coming in, a small LBO firm coming in and saying, this is a solid company, solid financials. It's not going away. People aren't going to stop having pets. They're not going to stop spending money for their pets' drugs. It's a $15 billion industry, and the company has no debt. So I could see somebody coming in here, leveraging up the balance sheet, and buying this stock, and thus we would get a quick cash out. If any one of these two things, one or two of these things happen, it's a great investment, and I think multiple of them could happen and be wonderful. So would I buy this stock? It's at $17.47 a share, and at that price, I would absolutely recommend buying the stock. So I started giving you stock picks of the week about 115 days ago. I've given you roughly one stock a week, just slightly under that. And here you can see how those stocks are performing. Again, Altria is a stock that I bought, held it for 56 days and sold it for a 20% profit. The rest of them are still companies that I hold. You can see things have started to go a little bit against us. We're actually down a couple $100 since since February 4th. However, I want to put that in context. The president has been in a trade war with China, a trade war with Mexico. The market in general is down. So, we're not kicking ass right now, but neither is the S&P 500. I'm not worried about it. I expect that we're going to continue to do well, and we're going to come back. We were profitable significantly a few weeks ago. I think this is a bump in the road, but we'll see how things go. That's all for this analysis. Thank you very much for your time.